Greetings and salutations. Good morning, good afternoon, good evening, and welcome to this extra special edition live stream of the Women of BSV. We are head to head today with Dr. Craig S Wright and Dr. Jimmie Lenz from Duke University. So welcome both of you to the Women of BSV, and thank you for agreeing to come on and do this with us. And at this point, I am going to hand over to Robin.
No introductions? All right. Thank you for joining us today. We are joined with Professor Jimmie Lenz, who is in charge of the FinTech program in the Masters of Engineering program at Duke University, as well as the Cybersecurity program in the Masters of Engineering at Duke. He implemented the blockchain program at Duke, and he's recently released a paper debating what asset class digital currency should be. Should they be their own asset class? And we are joined by Satoshi himself, Dr. Craig Wright, whether you believe it or not. And I will hand over for Jimmie and Craig to introduce yourselves. Jimmie, give us a little bit about your background.
Sure. Thank you for having me here. Let me stop that. Thanks very much for having me here today. This has been just fantastic. I really appreciate the opportunity to do this. So I come from a little bit different background. I come from about 25 years in finance and decided to make some changes. So I do have a pretty in-depth understanding of the financial side of things. But I decided to put my education to work in a little bit different way. Came to Duke about 3 years ago to start, as you mentioned, two new graduate programs here in the engineering school, the Master of Engineering in Financial Technology and Master of Engineering in Cybersecurity. One of the things that I noticed when I started the programs was a really intense interest in blockchain. And so we've gone above and beyond there. We now offer a couple of classes in blockchain, kind of an intermediate or a introductory class, a more advanced class, and then we are going to be offering a Web3 engineering and security class in the fall. I've also started offering a blockchain class on Coursera. And it's just been, and they're different kind of student, right? They're kind of early career, mid-career students that are just looking for the information. And so it's given me a perspective and it's given me a lot of opportunities to think. I also run a lab here, the Digital Asset Research and Engineering Collaborative. It's an open source lab here at Duke that we are publishing out some papers, including the one that you mentioned, on the kind of questioning, where does digital assets lie as far as how you think about them in terms of more traditional finance and regulation and all of those kinds of things. I do try to keep my hand in kind of the finance side of things. I have a secondary appointment as a professor of financial economics at Trinity College here at Duke also. So I do try to base everything in that side of things. And with that, I will hand it over to back to you, Robin.
Well, I'll take the moment to brag about your program a little bit because I'm super impressed with your program. How many applicants do you get every year wanting to study blockchain?
So in the FinTech program, I had about 900 or 1,000 applications for about 100 seats this year.
And you're growing to 300 seats next year, is that right?
No, I'll grow to about 120 next year.
Okay.
Don't push it. Don't push it too fast. I think it's important to have a little bit of a regulator on there. I mean, the hardest thing is finding professors. Honestly, finding professors that have industry experience and that can teach. And so, like my advanced blockchain class is being taught all remotely because the only person I could find that I thought had really good qualifications for this is in San Diego, and he's not moving to Durham, North Carolina. So he will be teaching from San Diego.
Well, maybe I'll help you recruit teachers then. But good to see that there's that much interest, obviously. And I believe you told me in your Coursera class, you also get a lot of executives. And I thought that was interesting to see executives wanting to understand Bitcoin and blockchain a little bit more, and that they're pursuing those routes. So
absolutely, there are a lot of, I would say, early and kind of mid-career folks in that class. The average age is, I'm guessing, 35 to 40. But they come from around the world. The students in the Coursera class are as likely to be from Berlin as they are Boston or Beijing.
right.
Really,
whereas your students right now are international students coming to America they've studied finance or economics, and now they're switching into engineering, and they want that fintech hybrid, and they specifically want blockchain. So I think that's fantastic. And we've said before, but your students are coming in with what, an average of 1.1655 average on their GRE with
perfect. It's actually closer to 169.2 or 0.3. So almost a perfect score on their GREs. That's the average. I think is right around 169, a little over that. And the students, primarily they are, I think the largest cohort are mathematics majors. About 35% of the students have math undergrads. Usually they're double majored, math and computer science, math and statistics, something like that. But that's where we students are primarily coming from. But they're from universities around the world. Our largest contingent actually come from the University of California schools. Yeah,
you did say that. That's great.
Yeah.
All right, thank you. Dr. Wright, would you like to introduce yourself?
Okay, so I'm a bit of everything. I'm 51 and I'm still in university. I haven't been out yet. I have taught, but mainly a student. Chief scientist of nChain. I made all of this stuff. So my simple thing is it's not crypto. Yes, it's a blockchain, but it's neither encrypted nor a currency. So it's not a cryptocurrency. eCash, DigiCash, they were crypto credits. They're all cryptocurrencies. Bitcoin's not. The first problem people get is not understanding that. I mean, it's not about decentralization. It uses decentralization to reduce cost and make a micropayment system. So many things that people get wrong about the system are out there that have been good for me in a way. They've enabled, while people are sort of mucking around, for me to patent half the things in this industry that will ever be there, and then more, but that's life.
Well, you just wiped out half my questions, but we'll go further into that. So when I stumbled upon Dr. Wright, I had absolutely no interest in figuring out who Satoshi was, but I had spoken at conferences around the globe, which is ridiculous because I was such a novice, and it shows how poorly the industry is, right? That novices are up on stage teaching other people. But anyways, when I stumbled upon, when I got interested in pursuing any research in who Dr. Wright was or who Satoshi might be, it was because there was a lawsuit in my backyard here in Palm Beach County. And when a gentleman died, the gentleman's father got an email from somebody in London, which happened to be Dr. Wright. And so I went on this deep dive of research to figure out whether or not this guy was Satoshi. And I adamantly believe that Dr. Wright is Satoshi. But one of the things that I read or that I started researching were Dr. Wright's blogs. And I think anybody interested or anybody wanting to know anything about Bitcoin, it's a fantastic, just a plethora of information. And you understand when you see Dr. Wright's background and all the different degrees that he has, you understand that this is a mind that would create something like Bitcoin, right? I mean, how many different degrees do you have now, Craig?
I don't know.
Over 20, over 30?
I've done 25 simultaneously. So
economics, computer science, right? Math, philosophy, theology.
Philosophy, theology, various mathematics. Yeah.
All right, so let's talk about fundamentals since Craig has already touched on them. Let's start with, bear with me, let me grab my questions. Okay, so is Bitcoin a digital currency, Craig?
Well, it's digital, but it's electronic cash. I mean, it's designed purely to be a cash system and micropayment. Now, when I created it, I built in a scripting system that allows you to build more. And that would allow you to build currencies, such as like central bank digital currency type systems. But currency is a legal term of art. So there are definitive things in what currency actually is. So you can't just go out there and go, it's a private currency, and say that it is. There are certain requirements that you have to meet to be currency. So currency basically means current money. It needs to be taken by people, not necessarily legal tender, but used in a similar way. So Bitcoin's definitely not currency. As a digital cash system, that's very different. Cash doesn't derive from some of the things that the BTC crowd run around saying, but it is a commodity. There are fixed valuations. Each token is effectively fungible. That doesn't mean that the values in a particular address, which is equivalent to a note or negotiable instrument, these aren't fungible then the same way, although they can be made that way. So people get it very wrong. It's not about decentralization. It uses decentralization to serve a purpose. It's an economic system. It's not a cryptographic system. It uses cryptographic primitives. It's not encrypted. But the control is all economic.
Right. So Bitcoin is not a currency.
Not a currency.
Not a currency. And how would you compare and contrast that with the so-called cryptocurrencies that exist today?
No cryptocurrencies exist today. The last ones were Liberty Reserve, eGold, and a few minor ones, but they've been gone for about 10 years now. Cryptocurrencies started with Shorm, and the idea is anonymity rather than privacy. So right. Bitcoin is a system that isn't private. Now, by definition, digital signature doesn't allow you to not have an identity. In the white paper, it actually says that identity is firewalled from the blockchain. That doesn't mean it doesn't exist. So many people get that wrong. The use of Bitcoin is misused right now. So how people use the system. It was designed with IP to IP transactions as the primary thing, which everyone said is not secure, but is actually more secure, which is I give, for instance, I wanted to give Professor Lenz something, I would directly hand it to him, and it would be his job now to send it to the node to be validated. And because I'm not the one who cares about the money being paid, he is. The recipient cares. I mean, I gave you the money. What you gave with it, I mean, here's the check. If you don't take the money, that's not my problem. For instance, I've got a check that I still get correspondence about from Telstra in Australia, because they owed me money and they had to pay it to me, and I refused to cash it because they keep sending me these letters out and franking them, and every 3 months I get $1 worth of value to annoy them with. Right.
Okay. So you were quoted as saying in one of your articles, people fail to understand, and I know this is one of your frustrations, at no point have you said that Bitcoin is a cryptocurrency, a currency in any form or anything anything monetary wise other than digital electronic cash. And so I think
I've used the term because you can create cryptocurrencies within Bitcoin, but that's very different. The same as you can make a digital bank type currency. For instance, because it is a commodity that allows you to write into the ledger, you can write other information, which would include if a central bank wanted to issue notes on Bitcoin, that would allow that to happen.
Right. Okay. Let's talk about the basics before we go into the debate. What is a commodity?
Commodity is a fixed contract for a set sort of item. For instance, people mix this up. They call gold a commodity, but gold isn't per se a commodity. Gold issued at 99.99, assayed this way, this weight is a commodity. So a commodity is something that you get delivered under contract, and it's traded for a delivery contract. For instance, wheat futures. And when you have wheat futures, you're not buying any wheat. You're buying a certain type, for instance, a class 0 durum that has been minimum of this standard that can be used in a certain manufacture.
Right. So in the most simple terms, it's something with utility that's offered in a standardized format and amount, right? Like crude oil. The definition of a standard barrel of crude oil hasn't changed, right? You've
Well,
said,
depends on which type of crude. I mean, there are multiple, but then if you're looking at Texas Sweet, it's very different to some of the others.
right. But so using the example of food commodities, right? Flour or beef, we need to know what grade, what type they're buying, right?
Yeah.
I think
So
that's the most simple.
pork bellies must meet certain standards.
Right. Okay.
Frozen orange juice, it must be the way that it's stored and everything like that. It's all defined. Right.
Okay. So, and then in contrast, what do you think how would you define a security?
Basically, it's an agreement where you make money out of the efforts of someone else. So the simplest definition would include shares, because you invest in the company and someone else does the work, but it includes derivatives, wrapped assets, fractionalized assets, all sorts of things where you have it's another form of contract once again, but where other people are doing all the effort for you, but you're the investor without necessarily having any risk, apart from the loss of the original money.
Okay.
It's much more complex than that, but I'm not going to go into all the legal.
That's a simple, yeah, we're looking for simple layman's terms. So is Bitcoin in its original design a commodity or a security?
It's a commodity. So it's a defined informational commodity. You're allowed to write a certain amount, the equivalent, I guess, of what you might have as a Excel spreadsheet entry to a ledger that will be maintained and record other entries. Now, people go, but that hasn't had value. But of course, information has value. Now, whether you use it to create knowledge or something else is a different issue, but it's very different from a security. Now, in a security, you would get more proof of stake. Now, proof of stake, the argument is it's not a security because we don't have dividends, but dividends aren't required for something to be a security. For instance, not only are there multiple types of derivative asset, but even in shares, equities, then Facebook doesn't pay any sort of monthly or quarterly or yearly dividends to any holders. So they're still a security.
Right. Okay. Jimmie, we'll go back to you. You've recently released a research paper titled Crypto Dynamics During Market Turndowns, Another .com Boom Bust Cycle. Talk to us a little bit about your argument in this paper.
Sure. So what we were trying to do, I mean, you hear the analogy all the time. People are trying to analogize the cryptocurrencies and .com booms. And so what our hypothesis was they're not. This is a very different type of asset class that then existed. And certainly it's not a security, as Dr. Wright mentioned. They are, I think they behave very differently. And one of the, the attributes is behavior, human behavior. How do these interact in a marketplace that is populated by people? And so we decided to look at cryptocurrencies, and in particular the behaviors around cryptocurrencies, as well as those that existed during the .com boom, late 90s, early 2000s. NASDAQ in particular, after the .com boom, NASDAQ fell by over 50%. And we saw people just flee, saw individuals flee, saw money managers flee those particular stocks, to the extent that NASDAQ didn't return to that same valuation for about 15 years. So it was quite long. And that happens in, all sorts of financial upheavals. People usually, that a generation, kind of a missing generation is happens often, and sometimes longer than that. And so we put, cryptocurrencies under kind of the same test. And we said, are we observing the same kind of behaviors when with the volatility, and when they, in particular, when they fall? And we didn't. We saw, in fact, something that was just the opposite. And we went through all the math, and we showed this in detail. But basically, what happened was something very different than you see in most types of securities, where people flee. Instead, over the period of time that we looked at, just the opposite occurred. People were actually getting in. We saw an increase in the number of wallet addresses and things along those lines. It's obviously cryptocurrencies are harder because they're virtual, right? They're exchanges all over, and so tracking some of that is rather difficult. But we used a few more centralized locations to be able to track those numbers. And what we found were people didn't flee cryptocurrency. It was the opposite behavior. We actually saw an increase in the number of wallets and things along those lines during periods when prices went down. Cryptocurrencies, like a lot of other things, do tend to be very highly correlated amongst each other. And so most cryptocurrencies, if they they go up as a group, they go down as a group. BSV not aside. And so that's how we were able to come to the conclusions that we did in the paper. We continue to assemble data on different cryptocurrencies and creating a fairly large database here so that we can continue to do research in that area.
Craig, what do you have to say about that?
Well, you haven't got a single wallet address because there's no such thing. What you have are effectively addresses which are very different. So although people misuse that, you shouldn't, I mean, the aim is to have a different address for every transaction. The number of addresses doesn't give the number of people anyway. So, I mean, you can have one person. I mean, on my laptop over there, I have about 10,000 addresses. They're all mine. So the thing is, I don't reuse them. So, and occasionally I split things between different amounts, and I even randomize. So you can say, oh, these are different sort of trades, but some of them aren't even trades. Some of them are just randomizing the amounts randomly so that it maintains privacy.
I think you would admit you are a bit of an anomaly, though. In that case, people do tend to. I mean, I can look at addresses, wallet addresses, and look and see, dozens, hundreds, sometimes of transactions associated with. But
you're not seeing wallet addresses. You're seeing addresses.
Yeah, the wallet addresses. I mean, I can look at wallets that I even that I have, and I can see dozens, hundreds of transactions. And so, what we used was, as we see more wallet addresses appearing, we analogize that to more people entering the market. Could it be the same people creating more wallet addresses? It absolutely could. But we assumed that in most cases, just from our and I would say they're beyond spurious observations. Our observations is that people do tend to reuse a single wallet. I know I do.
Well, you use a single address, but you also get payments to multiples. So if you look at different change addresses, you're still going to end up with different change addresses. You probably just don't follow any of those. So when you make a payment to that one wallet that you have everything coming into, all the bits go out to different ones.
Yeah, and and I don't use a lot of payments. Mine are mostly for honestly for work, schoolwork, that experiments that students are doing, things along those lines. And so I do tend to have class wallets that exist for strictly for that purpose. But for the purpose of the paper, we used the number, the increases as a proxy for individuals entering the market. But granted, I mean, could the same people be creating multiple wallet addresses? Sure, they could be. I mean, we know how easy it is. Anybody can do that, and it is fairly simple. But I think strictly for ease of use, I mean, people. I think most people don't tend to use a different wallet every time they have a transaction. I don't know. Would you give me that?
Well, no, because the terminology is wrong. The address and the wallet are different. So the wallet is the thing you hold your addresses in. or your keys and your tokens, etc. So you don't actually have a wallet address. So even if I have a variety of addresses, they're not wallet addresses per se. And even then I can still copy some of those to a different machine or a different wallet. So the way I would look at it would be, if you have sort of a wallet, it can hold many addresses or one, but it's still no address for that wallet.
Okay, so there are addresses.
Yes.
Yeah. So we were just looking at the proliferation of addresses and associated those with individuals.
Yeah. Unfortunately, the number of change addresses also increased. So if you look at the even BTC Core software, you'll note that it will spit out change to different addresses, or Electrum and things like this will create more. So even if you're getting them all sent to the same address and getting rid of all your privacy, you'll still have the sort of creation of many more addresses as you use anything.
Oh, as you continue to go into the environment.
Yes.
Yeah.
So the more one person sends things back and forwards to an exchange, even the more interactions they're going to get on the network, the more addresses they actually create.
Generate, yeah. But fundamentally, we still have a problem, because Bitcoin is one thing, and cryptocurrencies are another thing. Back to the earlier conversation. Yeah. And Jimmie, of course, you're trying to be neutral, teaching a blockchain program at a major university, right? So fundamentally, we're not necessarily talking about the same things to begin with, right? So important distinction.
Absolutely. Yeah, we do try to stay very neutral about those kinds of things. We have to. We want students to be able to make up their own minds, and to come up with their own considerations. Right. That's one of the great things I think about school, is that we provide a lot of information, but I don't want to lead students down a single path. I want them to be able to think much more broadly than that, and even in the realm of cryptocurrencies, which I know Craig doesn't agree with the terminology, the cryptocurrencies. Right. There are different things out there. We have central bank digital currencies now. We have NFTs. We have a lot of different types of digital assets that exist in the environment. And so even amongst those, I mean, there are, I would say, some rather significant differences.
Okay.
So my question for you is, if you're doing a physics program, would you teach someone how many turtles there are that the world sits upon?
If I was teaching a physics program, probably not.
So would you say what you're doing is scientific?
No, I mean, not everything that we do is scientific. I would say we are providing a good bit of information to students on a particular area, and letting them, allowing them to draw some of their own conclusions with oversight.
But wouldn't it be better to have it as a scientific program and test assertions?
I mean, we do a fair amount of experiments. We allow the students to provide, or we provide students with the ability to do, like I say, a number of different types of experiments, simple things from simple transactions on blockchains, all the way through creating ERC20 tokens. So we certainly allow students to do a lot of things there. We will be doing more as far as coding. Next semester, we'll be doing more in the realm of smart contracts and using Solidity to facilitate those. So we're certainly treated in that way, allowing students to do that. Is it a science per se? I would say not at this point.
Why shouldn't it be? You can test assertions.
I can test a lot of assertions. Go ahead.
Go out there and you can measure the network distance. You can look at how things are set up. You can look at what a node does. I mean, all of these are easily testable under a variety of different scientific principles, whether you're doing mathematics, computer science, even using some of the things from physics. You can look at the network connectivity. You can realize that every single node that is a real node will give you a list of addresses that it's connected to, which means you can easily map out the connectivity of the system. you can figure out that the distance between nodes is d equals 1.0001, which means it's basically a complete network, or as close as you can actually get. You will figure out that the only, currently in BTC, 103 machines since 2011 have created blocks. You'll start to work out that the only consensus mechanism, hence validation, is creating blocks. With a distance of 1, you'll realize that it doesn't matter if you've got a billion so-called nodes, 3 machines basically set what happens on the network. And Ethereum too.
Yeah, I mean, we certainly, as I said, I don't know that it's mature to the point where I would feel comfortable calling it a science. We certainly provide, though. I mean, I'm in engineering school. We build things here. You know, that's kind of what we do. And so we are providing, I think, students with a good background. You know, do they test certain things? Absolutely. Are they researching certain areas? Absolutely. But I don't know that I could put my arms around it and limit it as a science per se. Not at this point. I think it's quite broad and it's almost impossible to do. But do we provide the opportunity to do a lot of the things that you mentioned? Absolutely. I think that there are a lot of experiments to be done. I mean, right now, if you look at the number of papers that are that have been published, it's a fairly low number in the big scheme of things when you compare it to other areas. But there are a lot of things in the works. There are a lot of drafts that I've seen. Funny, not very many that are around network effects, which is something we've been talking about a lot.
We literally just had a conference about this, yeah. a meeting about this, right?
Usually mine and then ignored.
The network effects, though, are interesting because those we're starting to see in a lot of other sciences are starting to use the idea of network effects on the behaviors and to use those to forecast and to understand, under different types of scenarios, what the behaviors would be. I mean, we use it in economics and finance now as much as we do in some of the biological sciences and things along those lines. And so that's something that I am very interested in understanding a little bit more in in the blockchain environments and how those will proliferate. In particular, the difference between some of the public blockchains and some of the permission to private blockchains.
No, there's no such thing. I mean, the definition of a blockchain is that you have the hash header out there. It's not secured because of encryption, like people say. It's basically a wide distribution of the hash header. So it's that information publicly available. So if it's not, I mean, you give me any private blockchain, I can run up 1,000 copies instantly. And the whole point is, if I have 1,000 copies, I have 1,000 possible worldviews, 1,000 possible examples of what happened. I can do Bernie Madoff all I want.
Yeah, the problem with that is it's very difficult to get institutional companies to adopt things that they see as being in the public sphere. There's a lot of fear there.
Every single one of them has a series of hashes that are public right now. I mean, if you start actually analyzing these things from an engineering point of view, you name one of those large companies, governments, etc., that don't use AWS.
Right.
There are a ton of them that are most are using some sort of cloud computing right now. Absolutely.
So then there are public hashes on databases that are actually searchable.
There are, well, I don't know that they're public. They're certainly on databases.
If you go they're certainly vulnerable. There's a liability regardless.
There's a liability, but there's also someone that they can hold responsible, or that they think they can hold responsible should something happen.
You can always hold people responsible. I mean, that's part of what I'm going through right now. I mean, for Bitcoin, the original, I mean, I've said this before, I'm the issuer. I didn't say that lightly because I'm actually I'm completing my PhD in law at the moment. I actually do understand what that term means. I worked for the stock exchange. I've worked for an accounting firm. I've worked for brokers. By putting my hand up and saying I'm the issuer, I understand completely what that means.
Yeah, I think that area of responsibility around things like cloud computing. One of the things that I hear often is the fact that there is a large company behind. I mean, there are other cloud computing companies, but there are three main ones that large firms use, and they do feel some sense of I think comfort around that. Whether the comfort's well placed or not, I don't know. But they do feel some sense of comfort around that. And at the same time, when you mention to a large institution using a public blockchain, that immediately disappears.
Because they don't have an understanding of what it is.
That's right.
I mean, that's really what it comes down to.
Yeah, the perception is it's public. And so that's a scary thing for I think when I speak with them. I'm not trying to convince anybody of anything.
And the wealth manager is making the same amount of money, living in the same neighborhood, driving the same car as you too, right? I mean,
yeah, I don't. I'm not trying to. I have no service to sell. I have, I'm not trying to sell them on anything in particular. So I think I get a fairly, I try to stay fairly objective when I speak with them, but that's kind of what I hear from them when the subject comes up. And then of course everything around crypto comes up, but using blockchain technology for purposes, within their companies, or, amongst, it's usually not within their companies. It's usually amongst a group, of companies that they deal with.
Yeah, but I mean, I remember the early days of the internet and other networks, and for years the same arguments went round with Novell, IPX, and all this other fun stuff. And people put in protocol gateways, and you would go through all the fun of having to connect DECnet to IBM to horrible. And eventually people gave up and went, oh, well, this this internet thing is just easy, and it doesn't change, and I don't need to pay a consultant every time Novell wants to change something.
Yeah, no, I remember very well those days of those intranets that you had to hook up to, and they were massively expensive. And they were so limiting what you could do, and they took forever. And it was when I first started trading, I mean, that's what we were using, and everyone had a different protocol, within finance, and that made. And so I do see those kinds of things repeating in some of the blockchains that are out there now, right? Is different protocols, different ways to do things. And, I'm in finance, at least, we had, there were a couple of prevailing protocols that were used for, in particular for orders for, beginning it was, just simple orders, then it became algorithmic orders and things like that. There were the CMS protocol and FIX protocol, right? And why did we adopt FIX? Well, there was a really big institution that said, if you want to deal with me, you're going to use the FIX protocol from now on. Otherwise, I don't know how long we would have gone down that road of these different intranets, and maybe even with the advent of the internet, you still had these people using different protocols.
Oh, it took ages, but I mean, it all consolidates down into one. And changing, I mean, this is part of why Bitcoin's meant to be fixed, because when you change a protocol, you have to have everyone in the ecosystem change their design, which is a horrible way of doing things.
It is a terrible way of doing business. It keeps consultants in work forever, and
until they're not.
for better or worse, you do have those kinds of things when you change those protocols, and you've experienced this time and time again. in different kinds of applications where, something new comes out and all of a sudden people think, okay, I'm going to have to, I'm going to be forced into this. And I think people are always afraid of when those kinds of things occur. I mean, we're seeing it now. We see it in a number of different instances, I think. And I do try to keep, pretty in touch with things in finance, across financial services. And so I think that's, as much as anything, when people see blockchain, that it is a little bit scary. Is this the next iteration of a protocol, and what would the cost of that be?
Yeah, worse than people think. But then they'll go down the wrong path many times. But I mean, I don't know if you remember, but during the 90s, there were also web IPOs, and they were decentralized sort of tokens issued, so that they could raise money.
Yeah, I remember the ICO. Yeah, no, I remember well.
I mean,
yeah,
we just renamed it, and suddenly it's different. This is completely new because it's no longer a web IPO; it's an ICO.
Yeah. Yeah, no, I remember that. Those during as you look back, and it's interesting when I look back, at finance in the big scheme of things. Things haven't really changed that much, and I know. One of the entrees that I give to the white paper is, this came at a very at a time of crisis. But most of my students remember how old they are. So when 2008 rolled around, they were really little kids. They were in grade school, and so they weren't affected in quite the same way. But I thought that was always one of the interesting things about the paper was, coming out at the time it did, shedding a light on certain practices in financial services, being able to have more transparency. At the end of the day, I thought that was one of the things that probably captivated me more than anything else, was this idea of transparency and being able to see into things. When I think back and I wonder, if we would have known, if people would have known, the amount of insurance being sold on financial products back in the 2006, 2007, 2008 period, would they have reacted? Would they have behaved any differently than they did? I don't know that for a fact, but it would have been interesting to know, how much interest was being, or how much insurance was being sold on bonds at that time, and would how would people have reacted if they could have seen that kind of thing? We have exchange cleared derivatives now that allow for that kind of transparency, and what's happened? Well, the use has gone way down. So it does. I mean, and I would love to hear. To me, that was Dr. Wright. That was the thing that probably about the paper. I mean, the technology captivated me, but it was this idea of transparency, being able to look into things like financial products and the distribution of financial products. Would that have changed the course of the financial crisis that we experienced then?
Some bits yes, some bits no. People will still do weird and wonderful things. The part that I hope we won't have, if we have a blockchain properly set up, single system records, is we won't have a Bernie Madoff, because there'll be one set of logs and one set of records. We won't have WorldCom, we won't have Enron. Some of these things. I mean, it won't get rid of fraud, because you still have people setting up fake companies and doing all sorts of other frauds, but there'll be an evidence trail and record.
Right.
So, I mean, part of the sort of aim of Bitcoin was to construct something that will minimize some of these frauds. Will it get rid of them? No, but it will make it more expensive.
Reduce corruption.
Mm-hmm.
I would hope so, but I would hope that just the exposure, the knowledge of that certain things existed. No, I agree. You know, there will always be frauds out there. I think a lot of the cryptocurrencies and some of the things going on around those are simple fraud. You know, there's little substance to them. If you look at some of the coin offerings, 5,
such as
6, 7 years
ICOs.
ago, you know, those were, you know, if you looked at the projects behind them, there was nothing. There was nothing there. And so, you know, I see a lot of that. So I don't mind these kinds of washouts and things along those lines. I think that it, you know, hopefully things come to a better point at the end of the day. But like I say, the you know, one of the things that I always posture was one of the reasons behind the paper and the reason that it was released at the time it was, maybe it was just finished then. But I like to think more than that, is the fact that, you know, it did offer up this layer of transparency. And I think that it was, you know, obviously my background is finance, so everything I do is in the context of finance, that it would provide a better opportunity to, you know, to assess things, and, you know, shed some light on things that weren't out there.
Well, yes and no, but not in the way people think about it. I mean, it wasn't to do with the global financial crisis. I started coding before that, and had started planning things well before. I mean, even back in 2010, I said to people that I started coding in 2007. So, I mean, it predates what happened. I wasn't prescient like some people think. But I was working as an auditor, and I have been in like universities and finance and things like this as well. And I was also trustee for a bank, church bank, but still a bank. I mean, it ran billions of dollars in assets. So, but at the end of the day, I wanted something that would be transparent, that would record all of this, that would have a record but still be private.
I mean, the idea behind that, the idea behind you know, more transparency would certainly, I mean, in particular, as we create more and more derivative products that allow you know, leverage to be you know, go almost unchecked. I would say, you know, it would seem that clarity is more needed now than it ever has been. The other thing that is occurring now, and in particular, this is in the United States, but all over the world to some extent, is the consolidation of financial firms.
Yeah.
I mean, there is, you know, 80% of the deposits in, you know, the top 8 banks, and we have 5,000 banks in the United States. It's I mean, it's rather extraordinary, the, you know, that and the same goes for other things too, right? You have more and more you know, or fewer and fewer companies that are in the investment banking side of things or in the brokerage side of things. And, you know, right now we have you know, as far as exchanges and things like that go, people don't realize there are a lot more execution venues, but they all operate in the same, you know, under the very, you know, very similar rules. The opportunity, I think, for individuals to participate is somewhat limited by the fact that there are so few participants, you know, offering participants in the marketplace.
Right.
Well, I mean, the other part as well is simplifying settlement and other such things. I helped build the broker network for the Australian Stock Exchange. This is back in the mid-90s, and the chess functions and settlement functions were still difficult. So having something that it is a single version of reality is just far simpler.
I couldn't agree more. I think one of the things that and I wrote a short article on this just for popular press on, you know, the idea between some of the cryptocurrency exchanges, Coinbase, Binance, Gemini, whatever, and the more traditional
all the ones that are
exchanges
going to go down
is significantly different, right? And you know, I think that these cryptocurrency exchanges, you know, whether you love them, hate them, you know, they have allowed people to see that, wait a minute, a single entity can act as a broker, can act as an exchange, can act as the clearing and settlement, and even a custodian if you want, and it all happens simultaneously. You know, one of the things that the traditional exchanges are plagued with right now is this idea of multi-day clearing, and so you have multi-day risk, and so that risk has to be insured against. And so, you know, places like the DTCC, which I think do a fantastic job, obviously, you know, they've been able to continue to clear things, but they assess, you know, fairly large amounts, and those, you know, to guarantee delivery, because it is a multi-day process. You know, if we were able to shrink that, you know, like some of the cryptocurrency exchanges have done, so that everything is basically simultaneous. I mean, what an advance that would be. I mean, that would be huge.
Except I think if you do a sort of sum of what is theoretically on offer across all of the different cryptocurrency exchanges, as you put it, I'll put it as bucket shops, you'll probably find that there are 30 million BTC on offer at the moment.
Say that again?
The total across all of the so-called cryptocurrency exchanges is about 30 million BTC.
Yeah.
I mean, if you look at the trading volumes and you actually analyze all of this, which none of them like you doing, and then you add them all up, there's a little over 30 million. Now, there's a problem there because, well, I didn't create that many Bitcoin. So, I mean, eventually someone's going to figure this out, and they're going to start playing the market a little bit, as always happens, and that's going to have some interesting effects.
Yeah, I think the lack of rules around the exchanges and the way you think about them. I mean, even on, I mean, one of the nice things about the you know, the traditional exchanges is you do have rules around shorting, for instance. You know, you have to be able to deliver, and you're going to have to, and a broker does stand in between. A broker is basically guaranteeing that by posting a fairly large amount, and that large amount covers the value at risk over that clearing period, of course. But the idea, or the idea that there are, you know, 50% more Bitcoin being offered than exist, that's, to say the least, just a little bit troubling, right?
Yeah.
We could say a fundamental problem.
Well, I mean, it's like the so-called BTC wallet in you know, South America over there now with El Presidente. And I mean, if you actually analyze what is being done in their wallet system, there are more in their wallet system than they actually have purchased.
Right.
Now, I mean, you sit there and say, oh, well, it's government management, but yeah, I mean, I personally think it's certain types of government manage things this way.
Yeah.
You've got a transparent system. You can easily prove what you have in both sides. So it should be simple, but of course you make it complex so that people don't realize that El Presidente is basically siphoning money off to Swiss bank accounts. And then when president becomes no longer president, oh, well, what a shame. Hackers. Yeah, hackers stole all my BTC.
Yeah, or he'll mysteriously die in another country and body never to be recovered.
Yeah, like many of the exchanges out there. Yeah, we got hacked. Malleability. I'm sorry, but malleability doesn't actually have any relevance to the reality of Mt. Gox.
Robin, I know there are a couple of questions that folks have, so I don't want to. I don't want to.
Before we switch to
I don't want to shortchange anybody.
No problem. Before we switch to an open Q&A and take some questions from the audience, I think I want to circle back for a moment because I think there's a couple important topics that we kind of skimmed over that I'd like to just go a little bit deeper, because these are things that are wildly misunderstood about Bitcoin or so-called cryptocurrencies. So Craig always, or Dr. Wright always talks about set in stone, and you guys touched on protocols and those protocols being set in stone, and you cannot have decentralization without those protocols set in stone. So Dr. Wright, would you like to expand on that just a bit more?
Well, decentralization isn't about the nodes. This is a big thing people get wrong. The nodes are actually meant to be limited in number because then you can actually control them. One of the functions is it's a game theoretic sort of fitness sort of idea where effectively the proof of work is a peacock tail. You spend a lot of money to prove where you are, what you're doing, but equally let people come into the market at will. So decentralization is meant to be not the nodes, but the individuals using the system.
The people.
So the people. So if I wanted to give something to Robin, I hand it to Robin. Now that got stripped out of BTC with a whole lot of man-in-the-middle attack type thing. Like, so you don't get man-in-the-middle attacks by handing it to a bunch of random nodes, but you get man-in-the-middle attacks by handing it directly to the person who you're actually communicating with. I mean, it doesn't make sense. So some of the security problems that they had with my protocol are senseless. They're just there because they wanted to change it. So decentralization is really the ability to directly exchange and then have it recorded. Now that is how you make things like shares that are built on top of Bitcoin far more decentralized as well. Because I can have odd lots, etc. I mean, one of the problems people don't understand is there can be minimum sale amounts on shares. So if you go to a broker, exchange, etc., and you have 5 shares, they won't sell them. You have to pile them up into a big group until you get 100 shares, for instance, to be able to sell. So if you have 100 shares, fine, but you can't even sell half of those. You have to sell all or nothing. Now, whereas directly you'd be able to sell a share. I want to sell a share today. So it's a different sort of mentality to many people, what they have. Now, that's what decentralization should be. It is a concept of allowing people to directly trade. There's no problem with that direct trade because if I'm going to correctly sell to you, you get we can do atomic swap securely, which means you instantly exchange the amount of money for the shares, both being tokenized. And that means if one part of the trade doesn't go through, the other part doesn't as well. So there's no needing an intermediary to do the settlement. It's just, I hand you, you hand me, we both let go at the same time, effectively.
Peer to peer?
Mm-hmm. Yes.
So in context of this conversation, since we're debating commodities, security, or its own asset class, you said before it's set in stone. The only way you decentralize something is to make it a commodity. You standardize, right? Bitcoin is a commodity given that the BSV token is the unit of transaction upon which other layers, contracts, and methods of securing data can be based, right? And then that is also why BTC and other so-called cryptos are not, I would argue they're not commodities, right?
Well, some of them definitely aren't. I mean, when you're changing protocol all the time, then definitely not. But if you talk about proof of stake, people are going, oh, it's completely different to shares. Really? I mean, I can have voting rights set up in all sorts of funky ways, preferential voting rights set up in all sorts of funky ways. So if we're voting based on the ability to lock away money, then I'm sorry, but that's not actually a equitable system like everyone's making out, where everyone gets an equal say. I mean, if you think about it for a moment, Mark Zuckerberg is in a decentralized system with millions of users. That there are millions of shareholders in Facebook.
Right.
Now, those millions of shareholders can attempt to outvote Mark, except for one little problem. He has 50% control.
Majority, yeah.
So you can vote all you want, except he wins. It's a great system. It's like if you vote in North Korea, you can vote anything you want and be guaranteed of the outcome.
So like a commodity, you can buy that unit, right? And the utility that it offers from anyone, anywhere, and you know exactly what you're getting, right?
Exactly.
So so there's this lawsuit, obviously, with Ripple and XRP being accused of being a security. What's your view of that
Oh, I mean, Cripple has been a security
Cripple.
for a long time. I told them about this in 2013
I know.
publicly, and they went, "Oh no, we're a cryptocurrency." I mean, I sat on with their founders in sort of talks and things like that back then, and they went, "No, no, we're different because we're digital." And I went
Right.
and discussed how shares dematerialized in the past, and there's no paper share certificates anymore. And they went, "Yeah, but we're different." And then you ask how, and they go, "We're crypto." I mean, that's not really an answer. I mean, if you think logically, it's sort of a bait and switch answer, and well, I'm not going to answer your real question, but look over here. Don't look there. Look. Yeah.
Right.
Yeah, I don't. The idea of it being a security, does it meet the Howey test? I don't. I don't think it does in certainly not in all cases. It's
Not at all, but
it's very different. And so, in that sense, it wouldn't be a security in the United States. Have to preface that. I mean, it's certainly not an equity, right? You have equity in nothing. It's not a fixed income instrument. It's not a bond of any kind. It's, again, you have no claim on anything. It's certainly not a future because it has no dates associated with it. It has no delivery type of mechanism associated with it. Is it a commodity? I certainly not in the sense of if you think about them as a group, not individuals, but as a group, I think it's tough to think about them as a commodity. And certainly in the traditional sense of the way that we think about it. And that was our argument is this maybe it is a type of instrument, a financial instrument, but I don't think it fits well into any of the ways that standard definitions that we would use for most financial instruments.
Well, so I disagree. I mean, the law degree that I did in the dissertation, I explored all of this stuff before I launched Bitcoin. So if we're looking at something like Ethereum, then I would go through how test and is it an investment of money? Well, yes. Is it a common enterprise? Yes. Is there an expectation of profit? Yes. Is it derived from the efforts of others? Yes. So you can argue, oh, we're in a big group and it's ourselves, but it's not. The efforts are the Ethereum Foundation. They do all the coding. They decide what gets put in. Even if you send them something to go in, I can send things into Google and Google might accept it or not, but Google are a gatekeeper. So it is always the efforts of others. There is always an expectation of profit. It is a common enterprise and there is an investment of money. That is the defined definition of the Howey test.
Yeah. Is there always an expectation of return? I don't think so. I mean, I certainly don't. I mean, I use it to put things on the Ethereum network, but I don't have any expectation. I mean, maybe I'm in in a different place. It certainly doesn't pay any kind of dividend.
But it doesn't need a dividend. There's no
yield. Might it increase in value? It might. But I don't know. Maybe. I mean, the argument can be made that the vast majority of people are that's why they buy it. An expectation.
Well, if you go to an exchange and hold, then you're not doing it. When you go to an exchange and you hold ETH, you're not doing it so that you can do anything else. I mean, if you're doing it for holding for gas, you have the argument that you're not using it as that reason, but then someone else will be buying it for that and receiving it for that. I mean, commodity, we're looking at a fixed contract. So people get it wrong. They think commodity means something like the actual item, like tin, dye, etc. But the correct legal definition of a commodity is very different to the actual common use of the terms. This is where I get into trouble all the time. I mean, I've got a background in both finance and law, and I speak in legalese, and definitions of terms can vary. So the sort of more of the vulgate, the common use of something, the popular use of a term can be very, very different. So unfortunately, that's part of the problem in this industry. But commodity refers to the actual contractual instrument.
Absolutely not. A commodity is not. It is a thing. You are buying on the spot market. If I buy, a barrel of oil, I own a barrel of oil. It's, I have. There's an agreement to buy it, so there's a contract. But you're talking about a future. If you're talking about something a delivery in another time, that would be a future.
No. You are a commodity is still, you have a sort of agreement to how it will be delivered, what you're buying, etc. I mean, it's still a contract for that item.
Well, I can go down to the warehouse. I mean, so I live in North Carolina. I can literally go down to a warehouse and I can buy, agricultural commodities.
I agree.
And take them away
and
with
you have instant delivery.
I have instant delivery. They load them, they put them on my truck, and I can drive them away.
I'm not disagreeing with that.
Okay.
But the sale is the commodity sale. So you're actually still talking about something defined. So when you're buying that, you're buying something at a very defined specification. You're not buying wheat. You're buying a grade of wheat.
I'm buying bushels of wheat, right?
Way. Yeah. So you're not buying it by the kilo.
No, buy it by the bushel, but
that's what I'm trying to get
there are
at.
other things, you can buy.
It is a set contract.
Right.
So if I want to buy like Texas crude, sweet crude, then I'm not buying a liter. It's not a commodity.
Barrels of WTI or whatever.
Yeah. So there are actually defined sort of specifications on whether it is a commodity or not.
Right. There is a defined specification on what you are buying.
Yeah. So that is why I would actually argue that when you're looking at a fixed token delivered that gives you this sort of format, unchangeable, can be used in these ways, etc. I mean, I can't say that BTC actually meet that anymore. They change all the time and they keep adding things. But I didn't create BTC. I created Bitcoin.
Yeah. Let me ask you one question that you brought something up that I probably received more questions on this recently than anything else, and that's around proof of work, and the impact of mining. What are your thoughts around that? And from the very beginning, obviously, I think in the abstract, CPU usage was probably in the I think in the abstract, I can't remember, but it seems like it was. So there was definitely a consideration of the resources that would that would be taken up with mining. What are your thoughts around that at this stage of the game?
Okay, so it actually changes as you scale. Now, the creation of signatures, the verification of signatures is actually harder than the process involved with verifying hashes. So people haven't thought about that. So when you get into millions and billions of transactions, you're still going to have a lot of validation, a lot of checking, but it moves away because the cost actually becomes more in the signature checking than it does in the hash function. And you can't validate a block unless you actually do the validation of the transaction. Now, the issue with BTC is artificially limited sort of a number of transactions that they put in there to try and push people off Lightning. And that all started not because of the number of transactions, which is all BS, or centralization, which is BS. It's to do with the fact that about 1,200 people have gone to prison because of Silk Road and other things now. And
which you testified on, didn't you?
Yeah. So some of the people involved in this industry they want cryptocurrency. So Lightning is a completely separate network that they're trying to build so that they have no records, no logs. Bitcoin has a record of everything. And that means years later, people get traced. And a lot of people don't like that years later, their drug deal is going to bite them in the ass. Just 2 years ago, one of the main guys from, or 3 years ago now, one of the main guys finally got caught in Thailand. And he should have stayed in America because Thai prisons are nowhere near as nice. Yeah, I mean, if you're going to get caught for drug crimes, don't do it in Thailand. But anyway, so he finally thought he'd get away with spending some of the money, and they traced it back through the exchanges and caught him. And now he's spent, and the Americans aren't trying to extradite him either. Funny that.
It's crazy to think that eventually we're going to have, if we do have one chain or one predominant chain, like the amount of data stored on that chain, it'll be like the largest data repository on Earth.
Potentially, but it's actually, because of the nature of the binary tree structure, able to be separated and fragmented and everything really efficiently.
It'll still be regardless, it'll still be the largest data repository. Dr. Wright, how many countries, how many intelligence agencies have you consulted with in the past and testified on things such as Silk Road?
No comment.
Fair enough. Ruth, I know you sat there quietly. Thank you for your patience. I believe you have a question.
Sorry, I wanted to say a bit more, but I've had two birds fighting outside my office, and then they found their way in. So, okay. All right.
A little bit entertaining.
It's a loud bird noise outside, you'll understand. No, I wanted to circle back to this sort of original point, the original paper that Jimmie Lenz wrote, where he was talking about how basically he contrasts Bitcoin with the dot-com bubble bursting in 2000. And I was just wondering if they were more similar than you thought, Jimmie, in the sense that internet users continued to grow that whole time. And maybe the dot-com companies that all crashed were like the ICOs, the Ethereum tokens that we've got today. You know, is it really the same thing happening, history repeating, really?
I mean, it's interesting. So we looked at the behavior, the people behavior side, the investment side, rather than the company side. If you look at it on if you treat a cryptocurrency as a company, if you looked at it as the number of those companies or the percentage of those companies that have gone bust or close to bust, it probably is much worse. Honestly, last count, I think there were 19,000, something like that, cryptocurrencies out there.
No, there's 30,000. There's over 30,000 today.
Yeah. I was looking at the coin market cap, but yeah, there's probably a lot more than that. I mean, and they're fairly easy to to create. So in with regards to the actual companies, the underlying those underlying cryptocurrencies, you're probably correct. We were more interested in the investor behavior, in the people that were actually buying into cryptocurrencies. And now that there are, it'll be interesting to see what happens now that you have more brokerage firms offering exposure. Sometimes it's not directly buying, sometimes it's exposure. But now that you have, companies that are offering different types of exposure, and some of the larger companies saying they want to expand that, right? I mean, Fidelity,
even ETFs, right?
Well, I mean, both ETFs and direct exposure to individual currencies. It'll be interesting to see, what happens. Is it is it fear of missing out, and that was the rush when prices dropped, or and now that it's available to everybody, well, now it's not as cool anymore, and people walk away. I don't know.
Well, I'm wondering. Do you think that fear is finally going to overcome greed?
Do I believe that what?
Do you think that fear finally will overcome greed?
It never has. I mean, Craig brought up a couple of the Ponzi schemes and scams that have taken place, and people still seem to be biting at that apple. So
when you look at an
I would
investment,
say fear always eventually comes into it, but
Yeah.
the problem is it comes in at one big rush.
Yeah.
Then everyone sort of gets scared at the same time, and they try and get their money out of, and the Ponzi's collapse. So Ponzi, but then there'll be another one, and the same people would put their money into the next Ponzi, going, "This one's different."
That's the trouble. Yeah.
Right. But again, if you think about traditional investing, you analyze the company's performance, right? And if you lived through the dot-com implosion, you saw all of these companies explode, and based on speculation, they had no real product, right? Like in the BSV ecosystem, we keep saying retreat to utility, right? We're sitting here discussing, is Bitcoin a commodity, and it has to have utility, right? So there's certainly a parallel between the dot-com implosion and the way that people have treated so-called cryptocurrencies as these speculative assets, right?
Mm-hmm. So, I mean, it's very simple when you look at this. I mean, I went through an IPO with a company that I founded in the 90s. And everyone told me how stupid I was because this is the internet and it's completely different and you're doing it wrong because I mentioned terrible things like profit.
How dare you?
How dare I? And people are going, no, this is the internet. It's a new model. You don't look at things like profit. And I kept saying, I'm running a profitable company. I'm going to keep running a damn profitable company. No, obviously you're not expanding fast enough. And then everyone else disappeared. And I was sitting there going, well, I don't care. I've got profit.
Yeah. Right. There's this thing called substance. I don't know.
Yeah, but to Ruth's point, I would say that in particular in the last 4 or 5 years, markets haven't reflected those underlying fundamentals that that you mentioned, right? I mean, if you look
all agree with that.
Yeah, I mean, who are the best money managers in the world? They're quant funds, right?
Yeah, well,
best performing.
But this is part of the problem. I mean, some of the quant funds have turned all of this into the same sort of game that we had in 2008.
Yeah.
I mean, when they're looking at arbitrage of what? I mean, if you don't know, I mean, if you haven't analyzed what the real value of something is, and you're going, well, 70% of the market says it's this and 30% says it's this, so therefore there's an arbitrage opportunity. Well, that's not really how arbitrage should work.
Right.
That's greater fool theory.
Hype and speculation, yeah.
And maybe the 30% are the actual ones that are right, not the 70%, and you have to jump, so.
Okay, should we segue? Should we open up the floor to the audience and take 2 to 3 questions? Gentlemen, do you have time for 2 or 3 questions?
2 or 3 would be fine.
Yeah, that'd be fine.
Okay, all right, I believe Diddy has been in the chat room, so she'll give us here. Okay, Chase Blakely, if Dr. Wright created Bitcoin but doesn't view it as a cryptocurrency, does he see a path forward for a digital currency flipping of the US dollar as a reserve currency? And if so, how would it look?
Well, no, it's not a cryptocurrency, and I don't see a flipping of the US dollar. There's not enough Bitcoin. It doesn't work that way. And the BTC bit where we're going to go to $1 million, well, then you can't use it. And if you start thinking about that for a moment, why would you hold something that you can only trade if it's over $1,000? Or actually, when it's sometimes even more than that. But no one's going to, the majority of the world are not going to use a system where you can't pay for it. And saying, well, I can buy a Lambo, so what? I mean, the reality is it's not about that. It's not going to have utility for that. And people are going to start cracking down on all of that. Government already has rules for anything over $10,000, and people sit there going, but there's no rules for cryptocurrency. Of course there's rules for cryptocurrency. Arthur Badowski from Liberty Reserve made that exact thing in front of a US judge. And he went, we're a cryptocurrency. You can't do anything against us. And the judge said,
threw him in jail.
They threw him in jail. They said, the law says funding. Funding means the exchange of value. It means whether you're trading dollars or digital assets or watches. And the judge actually said watches. And because you could have a bunch of Rolexes that you're selling.
Yeah. Okay. Shall we take the next question, Diddy? Doc, question for Craig. Is there a delicate balance between being struck, rather, to achieve privacy on Bitcoin while allowing for law? How did he strike that balance? And how confident is he that the balance is correct?
If people use it correctly. So as Bitcoin scales, it actually becomes an NP hard problem, and the number of addresses should split out and not be reused.
Right.
Now, ECDSA allows for homomorphic key additions, and it means you can make an infinite number of addresses while still having a registered PKI type key, and maintain absolute privacy. Now, you can argue that the person I'm dealing with will know who I am, but the person you're dealing with knows who you are if you're buying and selling real goods. Even in Silk Road, people knew who you were. I mean, that's why there were lots of little problems, because the drug dealer knew who you were and had a record. So yes, privacy for good things. Now, the balance, though, is taking it away from the NSA surveillance model and going back to the old human intelligence model. So if a policeman wants to do something, he has to get an order against this person and then follow it to this person and follow it to this person. Now, that's expensive, and it is for a reason. Then you go after only the big guys, the high-end, high-value type trades. You follow things back properly, the way that people used to do when we had cash. Now, this is even better for following back for these guys, but like everything else, it requires that people actually use it correctly. They don't reuse addresses all the time. They actually start implementing something where they have many, many addresses and use every single transaction differently.
Diddy, one more question. Vincent Bookmarks. In which way, if any, does the new Digital Operational Resilience Act, DORA regulation affect the Bitcoin BSV network? How does it affect BTC?
I think the law already applied. I mean, many of the problems people do is misunderstanding what Bitcoin is, and throwing words like cryptocurrency into a law. If you got me into the courtroom, I'm going to tear it apart. So,
do we have any questions for Jimmie?
Mm-hmm.
Should we share one for Jimmie before we go?
I only have one more question in the comments box.
Okay.
You'd like to see that one? But it's not for Jimmie. It's kind of...
That's all right. We'll take one more. And can we share Craig's blog, Jimmie's recent research paper, and also the BSV site for data?
Yeah, so Craig's blog is in the comment box, and the link for Jimmie's paper is in the comment box, and the other
perfect.
Thank you.
as well.
Thank you. It's hard to see on our end of the broadcast. All right, Chase Blakely, if a cryptocurrency can't replace our current fiat system, then what is the goal of the whole movement? Why can't we denominate a cryptocurrency and purchase items via fractionalization?
Because the goal of the whole movement is to have micropayments. Now, if you think about it for a moment, Google, Facebook, they lock you out because they have an advertising monopoly. Over 80% of the advertising industry is under the thumb of these guys. That's how all of the internet makes money now. If you want to come in there, you can't come in as an external player without coming and going, excuse me, can I please play? With digital currency, you can. There's no one who can stop you anymore. It opens up global markets in a way that, who knows? It means that someone in Ghana can start just running a server and start trading. Now, on top of that, it allows very small payments. None of this BTC, it's not for $2, people earning under $2 BS. It is for everyone, and being able to open up, not banking, cash digitally. changes the way that we trade. So on a mobile phone, someone in Nigeria, a fisherman, can call in and go, hey, I've got a load of fish. Would you like to buy it? Someone can then escrow a contract, have it held, and have everything ready. You know that you have it. Like, you can send photos, and someone can come down, and it might be 50 cents worth of sales, but you can do it. So it's not about huge big sales and all the rest. Yes, you can set all these things, but you require intermediaries for that still. I don't care what people say. If you're doing a multi-million-dollar sale, you still have legal obligations. You still have FATF requirements. You still have the recording of information. Can you do that using the blockchain? Yes, but it's not like everyone's going out there. Smart contracts. Smart contracts have been around for decades. They're called EDI.
Electronic data interchange.
Yep. I mean, I set these things up back when Staples was called Corporate Express in Australia, and people would send them through, and like simple little coded transactions would act as both a purchase order and then invoice, and all that just automated. People went out, everything got picked in the warehouse. It happened. So automation, well, this is not new.
Right.
Would it be fair to say, Craig, that you think that currencies are only issued by governments in that case?
No, currencies are not only issued. There are private currencies, but there are requirements for it, and there are bank currencies too. But it's far more complex than people like to make out. So currency is different to money. Currency is a very particular form of money. I mean, I can give people a nice book that I've got behind me to read if you want to know a little bit about this. There you go. It's thick enough to be the Bible on money, but it's fairly much the legal Bible on money. And I can give you one on the other too. If you want EDI and the law, just happen to have that one there too. This goes back to the 90s, and all the stuff we're talking about goes back to the 90s.
Well, it's good to know. It's good to know. I mean, is it fair to say then that the original definition of Bitcoin as magic internet money might have been the closest?
No, because he just told us it was EDI.
Well, no, that's smart contract.
Or magic internet cash, if you prefer. But I mean, is it principally its use is for small purchases over the internet?
And recording information and much more.
Yeah.
I mean, the reason I put all the scripting capabilities was so that people could do other things. Not that it ever took off, but I tried actually building businesses on these things in the past. With a guy in Australia, John Keeble, we tried building a smart meter project. That didn't work out because no one trusted any of this stuff back in 2010. Funny enough, back in 2010, if you went, hey, it's a blockchain, people would go, what the hell's that?
Yeah.
So,
do we have any more questions, or shall we wrap up?
We have one question for Jimmie. So Carboncraft, I asked Jimmie if he is informed on BSV capabilities and its history as the original Bitcoin protocol.
Absolutely. I've had an opportunity to speak with several folks in the BSV community, including people that are actively involved on the technology side right now. Almost all of those introductions via Robin, so I have to give credit where credit's due. But she's had the opportunity to introduce me to a number of people on that side, and people that are people that are working in this. I would say very prolifically working in this space right now. I don't want, because we have harkened back to the 90s and the early 2000s and things like that. It almost feels like we're talking about something that's relegated to another time. But one of the things that I have been very impressed with is some of the folks that are doing work in this area right now. and that are publishing, their findings, of publishing, the results of their work at just an exponential rate. There is quite a bit out there, I think, in the space that's going on right now, and that's, to me, one of the things that's really exciting is the opportunity to see all of these things, continuing to receive a lot of attention. I love the fact that students want to know more. That I have, mid-career people that want to know more. What is this blockchain thing? What, that are craving this kind of information. I think that's always a good thing when people are looking to expand their horizons. But you do see quite a bit of work being done in the space, which I am very impressed with, and I do read a lot of that work. I mean, like Craig, obviously a prolific reader. I have stacks of books that I really do continue to read. And yes, I love the tactile sensation of holding a book in my hand and reading and writing notes. I saw you had notes on yours. I still write notes in the margins.
I do too. I put them all over the place. I write all over the damn thing. Some people get annoyed, but
it feels like sacrilege when you write on it. Ah.
No, books are tools.
I don't even underline things.
Yeah.
All right, gentlemen, I know you've given us way more time than we had allocated, so I thank you for that generosity. Do you want to leave on a final closing thought?
I'll just say the
Please.
carbon bit is very simple. By the end of the decade, we are aiming at getting billions of transactions a second. And the proof of work will still be the same. So if miners are earning money because of the transaction volume, then what's really happening is that you're getting cheaper and cheaper and you're using less energy over the time per transaction. And that's what really matters. It's the energy per transaction. And if that's cheaper than Visa, cheaper than banks, cheaper than MasterCard, cheaper than anything else, then that's your comparative.
Yeah. And we're working towards a fee that's 1,000th of a penny, right?
Yeah. Everyone keeps going 100th is a good enough thing, but no, it has to be 1,000th.
Yeah, it wasn't the goal. Jimmie, final thoughts.
Robin, I appreciate the opportunity to do this. Dr. Wright, it's been a pleasure meeting you and having a chance to chat. Ruth, Diddy, fantastic job facilitating all of this and keeping it on track. I do appreciate it, and I look forward to hearing a lot more. I am always very, very interested in new work being done in the space, and if there is more being done, or any questions that I can answer or assist with, please use me as a resource.
Wonderful. Thank you.
Thank you.
Thank you, Dr. Lenz. And I know you've already met and spoken with who we call X-Man several times, and we've already introduced things such as S-script here to some of your students. And so I appreciate you having that neutral stance and really just trying to educate and provide different data points so the students can find their own path, if you will. So thank you for that. Thank you, everyone. We should close out now and say goodbye.
Bye now.
And don't forget to like, share, and subscribe. Thank you.